Hello and a big welcome to the Rise High tribe out there. Thank you for joining us today. Today I am joined by the wonderful Thuy Nugent, who's one of our amazing mortgage brokers at Rise High. And we are going to be talking about buying or building your new home, and specifically, everything about construction loans, because this has obviously been a really hot topic of late. Lots of people interested in building new homes at the moment. There's a lot of buzz around. So we're keen to go through all of your questions. We've already had a lot come through from most of you today. So please feel free to send any more questions you've got through via the comment section below, and we would love to answer them during this segment. We'll be live with you for about half an hour, and definitely here to answer all of your questions. And I did invite Thuy because she is an expert at all things loans, but in particular construction loans. Very good. So she will be sharing her wisdom and knowledge with us today.
Yes,
Thanks for joining us, Thuy.
Thank you. Pleasure. Lovely to be here.
So we're going to start at the beginning, and really it's all about the goal, the dream, which is the new house.
Yep.
So there's a few ways to go about it if you want to buy or build, or if you want to move into a new house. What are the options that people have available to them if they want a new home?
Yeah. So the most common one that we see would be house and land packages. This is where you would visit a display centre and talk to a building consultant, and they can help you source the land and put a package together with the build and design a house for you on that block. The second option would be to source your own land. And then you would find a builder after that and then design a house to put on that.
And with that option, could that also include, perhaps you love where you live now, you just want a new house, so demolishing your existing house and building...
Major renovation even,
yeah,
or demolishing and rebuild. We see a lot of that. And also there's off the plan options as well. So those are essentially you pay 10% deposit, and then there's no construction involved at all with a off the plan type of purchase. So once the property gets built, then you pay the last contribution.
And those off the plan purchases can often have a long lead time, in that you might sign a contract today and pay your 10% deposit or whatever the percentage of deposit is, and you may not actually move into your house for
12, 18 months even.
24 sometimes, 36 months sometimes.
Yes.
Sometimes they can drag on a bit. So in that scenario, that's really about sitting and waiting until the property is completed. This is really common for apartments.
Yes.
Or townhouses, things like that. So, but there are risks associated with off the plan, aren't there?
Yes, there is. A lot of the contracts that we see are unconditional, which means there is no subject to finance, which means that you could lose your 10% deposit if 18 months down the track comes and there's been a change in your circumstances. For example, you're no longer working in the same job, you've got less pay, and you are unable to get the loan that you need to settle this off the plan purchase. Potentially, you could lose your deposit, or you have to force to sell it for under what you paid for it.
But even if your financial circumstances don't change, the banks can change their policy.
Correct.
Or the valuation might not come in as high as your purchase price when it's finished. There are a lot of risks.
It's a lot of uncertainty, so you have to make sure you weigh up the risk of that type of purchase over a house and land package where you know that you can get the loan approved.
So would you say the other options we discussed, like the house and land package, building a house on a land that you already own or a land that you source yourself, and also the renovation extension, would they be safer options from a finance perspective?
Yes, they would be. So we're leading into the finance part of things now. So when we do a house and land package, we would apply for you to buy your land, and that's a full approval. And then we would couple that with a pre-approval for you to build. So then you know for a bit with big certainty that you will have the funds to build as well.
That's such a great tip, because often people buy the land and get really excited. They might even pay off the land, and then they need to borrow the money for the build, but they haven't really even considered whether they would be eligible for the finance for the build, and then the piece of land that they've got may not necessarily bring them the end goal that they're looking for. So it's so important to plan ahead. and to have that forward thinking and getting that
That's
pre-approval for the build at the time that you buy the land.
Very important.
You know, how much difference does that make?
Huge difference, because you don't want to be in a position where you have this land, you're making repayments on the land, you've been working with the builder over a course of 2 to 3 months, to then find out that you're having problems getting the loan to build. It's just not a good experience for anyone. It's stressful for everybody. So we want to make sure that you're looked after. We're forward thinking. We're making sure that the process is going to be smooth for you, and the outcome is a good outcome for everybody.
Yeah, because there's so many advantages of buying or building new, isn't there? Like, what are some of the advantages that people, and I guess this is why there's so much hype around it, especially for first home buyers. You know, what are some of the advantages that you see in terms of opting for a brand new home versus an established home?
So the first one that I could see is the savings on stamp duty. So stamp duty is the government tax, and it's only on land. If you buy a house and land package, So if you buy a house and land package, the stamp duty only applies to the land portion. But if you buy a house that someone has built and it's still brand new, but because the house is already on the land, then the stamp duty will be on the whole thing.
So that can save tens of thousands of dollars.
Yeah, it's probably half of what you would pay.
Half of the stamp duty.
So that could help you with the lower entry price into the property market. And then there's grants as well.
Which of course is great for first home buyers who may have a lower deposit and they may want to sort of get into the market a bit sooner.
That all of those things come to help you get into the market with a lower entry deposit.
There's also a lot of grants and things available. What are some of the grants that people might consider when they're getting a new home?
Well, the one that is specific to South Australia that's been going on for quite some time is the First Home Buyers Grant, which is $15,000.
And most states have something similar for first home buyers. But there's also other things, like in some states they have stamp duty exemptions from time to time on certain types of property. Then you've got things like the home builder grant. So there are different grants that come and go at different times. So it's really important, I guess, would you say, to speak to the mortgage broker and understand what grants are available and what you can use to your benefit to help you get into your property sooner.
So we would go through all the grants and the government incentives with you, and then it becomes a process of elimination. What are you eligible for and what you are not, and what kind of parameters and guidelines you need to meet to qualify for those grants.
So we spoke about some of the advantages of buying or building brand new, and we have spoken, you touched on one of your finance tips, which was a great one, which was to get a pre-approval for the build at the same time as purchasing the land. But I really would like to move on to some more financing tips for people as to, what are some of the things that they should be aware of. And just before we get into that, I'll do some shout outs because we've got a few people online. Hi Priya, Emily, Giselle, Adam, Susan, Richard. Thanks for joining us, guys. Please feel free to put your questions and comments below. We'd love to hear from you and love to hear your thoughts and questions as we go. So getting back to my question, Thuy, it was in relation to financing tips. And there was a little nugget of gold shared about getting a pre-approval for the build when you buy the land. But what other tips can you provide our audience as to things that will help make the process go a lot smoother?
So the other common one that I really recommend clients do is when they buy their land, to keep the land loan itself as a variable rate. I know sometimes fixed rates can be quite low and very attractive, but there is some advantages to keeping your land loan variable, and it can come down the track when you have the build contract together. When we put it all together, we need to get it valued as if it's a completed package, and sometimes the valuation can come through in at a lower price than what you've paid, and most times it comes in at the same price. But then if that happens, we've got the flexibility to contest the valuation, and if that doesn't get us what we need, we might have to look at changing lenders. So if you're stuck in a fixed rate,
it's important to have that flexibility, isn't it?
Yes.
Just to have that flexibility of potentially being able to move that loan if necessary in order to achieve the build.
Yes.
And I'd love to touch on the other risk that you just talked about there, which was valuations. Can you just explain the valuation process for our viewers, because that's a little bit different than normal. You know, normally when you've got an established house, the valuer will come and inspect the house and measure the house and provide a valuation report based on the house that they can see. But in construction loans, it's a little bit different, isn't it?
It is. It's a lot different. The first thing would be the land. The bank will value the land for what you paid for it. And then we have to get you the build pack, which is essentially the documentation pack from the builder, which finalises all the build numbers. So finalise I guess the plans and specifications and the costing. Then we would package that together, present that to the bank, and then the bank sends out their valuer to value the whole thing as if it was completed, as if it was fully built.
It's amazing. The valuers actually picture in their mind what it's all going to look like based on the plans and specifications we give them, and that's how the valuation's determined. And we can actually borrow against the end value, can't we?
Yes, correct.
Even though we're not there yet. So that's a really good bonus as well. And that's the same process for renovations and extensions. Is that correct?
Yes. So the bank would value the land or the house as it is, and then they would add the modifications, the new additions that you're going to add to the property. They put it together as if it was completed, and then you can borrow against the final value of the renovation.
Yeah, which is sometimes handy if you're wanting to do a renovation or extension that's substantial, you don't currently have enough equity in your property at the moment, then you can do that as if complete valuation, incorporating your improvements to try and get that little bit of extra equity to try and get the money that you need for the renovation and extension.
Yes.
Okay, some really great tips there. So pre-approvals on the build, make sure the valuations are done as if complete, keep the land loan variable. What else can we add there, Thuy?
Cash flow. So cash flow, I think, is really important for you to keep aside a bit of a buffer, because as you go through construction, the builder will require repayments. And I'm assuming that if you're renting, you definitely need to have a buffer, because as the builder requires repayments, the bank will release that money to the builder, and then you will need to make repayments on the capital interest of that loan.
So what you're saying is that obviously as the build progresses, your loan against the build will increase.
Correct.
And so will your interest repayments increase, and you still have the obligation of rent if you are renting.
Yes.
And sometimes, as we know, builds can sometimes go overtime.
Yes.
Unfortunately, that's quite a common thing for a build process, or even a renovation process for that matter. So just having that cash flow to enable you to afford your rent plus afford the repayments at the same time.
Correct.
You know, for someone who's a bit nervous about that, and who maybe they've got good equity but they just don't feel confident they've got the cash flow to sustain that period, are there any options for them?
If they have equity, we could technically borrow some of that equity and put into a bank account for you to use to fund the construction.
And to fund the repayments during that period.
The repayment. You could also, I guess, put a bit extra savings aside to help cover that during that time. Or move back with your family, mum and dad.
That's another good option.
To save money. Why not? It's a short term.
Not an option for everyone,
no,
but for some people.
But if you can, that'll be a really good cost-saving option for you during the construction.
Yeah, but like Thuy said, for many borrowers, they might have the ability to actually borrow the money that they need to sustain that period, to make sure that their cash flow is it maintains at a strong level during that period. So that's that's another really good tip. What about are there any other things that we need to consider for new developments when it comes to valuations or?
So from time to time when we're dealing with a new development, so it's a new estate,
like a new land estate,
land estate, and there has been very little property built in that area, so the banks and the valuers may not have a lot of data in terms of sale price for the area, so valuations could be quite heavily skewed one way or the other in cases like that. The other thing is that I've seen come through lately is a buyback clause for the land from some developers, so that's getting technical, but they're saying, look, essentially we'll sell you the land. If you can't build within, for example, 18 months, we have the right to buy it back for 10% less what you paid for.
So you've got to be careful of those fine print, the small clauses in the contracts, especially with those new estates.
Yep.
We did have a question come through from Sasha. She wanted to know if she could have interest only during the construction period.
Yes. Most lenders will offer you interest only during the construction period, and that's just the way the banking system works because your loan is constantly changing. It's constantly being drawn down, so to have interest only, and also helps with your cash flow as well with interest only. There are a few banks that offer principal and interest. If that is important to you, let us know, and we could also direct that lender to help you.
And even if the loan is interest only during that construction period, it doesn't stop you from putting more money into the loan.
Absolutely not.
Paying it off faster, or maybe linking an offset account against it where you can build up some savings. It's always good to have a bit of a buffer of savings when you are going through a construction process, isn't it?
Look, I like the fact that it's interest only during construction, and I can make extra repayment, but I'm in control of the repayment that I make. In case there are contingencies, then I can redraw it
which
later.
Is often when it comes to construction.
Yeah.
We also got a question from Tom about the difference between getting a fixed price build contract from a builder and building it as an owner builder. So can you explain the difference between those elements and what that means?
Yeah. So I think about 95% of the build contracts that we see are fixed price contract builders with a qualified builder.
So what does that mean? That means that there's a fixed price on how much the build is going to cost?
Yeah, essentially it's priced, and then once it's all locked away, there's no more changes. The builder can't come back to you and say, oh, we underquoted you, and here's another 10,000 on top of it. So fixed price means fixed price.
And that can change sometimes if the clients make variations.
Yes.
You know, so sometimes you enter into a building contract and you're really happy with what you've decided, but then along the way you want to upgrade certain things or change certain things.
Yep.
So how do those variations work when you're dealing with a fixed price contract?
So when you initially sign the contract with the builder, it's just really a shell, and then you can negotiate with the builder to add things, take things out, and then they become variations to the contract. And then as you work with the builder, you make changes, and then the prices, get finalised. And then once it's all completed, and you do that final selection with the builder where you select the tapware, all those prices are set in, and they hand over to us the actual build pack, those prices are set.
I know, speaking from experience, not only as a mortgage broker, but also as someone who has been through a build process myself, you know, it's so important to try and really dig deep to understand what it is you want before you sign the build contract, because whilst you can make variations throughout the process, they're generally more expensive if you do them throughout the process than negotiate them up front. Plus you can find that the budget can get out of control if you keep changing your mind on things after the process has started. So word of advice is try and really do all of your selections and really make sure you're happy with the build that you're going to get before you sign the contract to minimise variations. Would you agree, Thuy?
Absolutely. And the more variations you have, the harder it is for you to keep in control of them all.
Yeah.
So, and then the other
option, you're sort of stuck once you've signed a build contract. If you want a variation, you can't sort of shop around because that builder has control of the site. So whatever price they give you, you're sort of at their mercy, aren't you?
Yeah. And then the other option was owner builder. So that I don't see that often. The banks are very tight with owner builders in the sense that you need to have qualifications as a builder.
So generally you have to have a builder's license at a minimum.
They've got strict requirements and restrictions if you want to be an owner builder. And an owner builder is where you will be building the house and sourcing your own contractors. So that's where the risk comes in for the bank.
And generally, you know, the lending, the LVR is a bit lower, so they won't lend you as much against the valuation.
No.
Generally, it's a more expensive loan because it's perceived as a higher risk to the bank, and generally more fees because many banks will want quantity surveyors to come and inspect the property and inspect the costings before they're willing to lend against it. So there's certain considerations. Obviously, if you've got the skills and you've got the license, then potentially you can save a fair bit of money on the build side, but you will be paying a little bit more on the finance side. So you have to balance and weigh up the pros and the cons.
Yes, and the time frame could blow out as well if you're sourcing your own contractors.
Yeah. Great. Now, we did talk about the fact that if you're doing a construction loan, you would need a build pack, which consisted of the plans and the building contract and the specifications. And we talked about that in necessary for the valuation. But what other information do people need to provide the bank if they are applying for a construction loan?
Okay, so apart from the normal stuff like your pay slips and things like that, the other thing that I think is really important is if you require works to be done, that you want to go to the source directly. For example, if you want air conditioning, if you want landscaping done or flooring, and you want to go directly to the source to save yourself some money.
So doing these things outside of the contract?
Correct. So we call them out of contract quotes. So you would source the quote, show the, supplier the plans, they give you the quote, you give them to us, and then we add them as part of your total house and land package to get it valued with all of these inclusions as well as the build pack.
And it's great to get those quotes up front before we do the valuation,
Absolutely.
Isn't it? Because then the valuer can take all of those things into consideration and can make sure that that's been priced into the end valuation.
Yep. And then the bank can then pay for those invoices as well.
So you can borrow, you can borrow
against that as well.
Yeah, it becomes a bit messier when people provide quotes after the valuation is done, doesn't it?
Yeah, generally, if that's the case, then we'll have, and you want the bank to fund that invoice or pay for that invoice, we'd have to get it revalued, and we'll have to make sure that it's part of the loan. Because if you provide that quote after the loan has been approved and after construction has started, you'll have to pay for that quote yourself, or
so it's not impossible, but it's messy.
It's messy.
Yeah. And then you've got obviously all the normal stuff like pay slips and all of that sort of stuff, the normal stuff that they need to see. Now, Shelley came through and asked a question about progress payments. So let's explain what progress payments are, how they work, and what role we play in the progress payment.
Sure. Yep. So progress payments are like builders' payment schedules. So at every milestone of the construction process, the builder will need to get paid. And generally there's about 5 to 6 stages, and they're called progress payments, and they're a percentage of the build price. So every time the builder finishes a major project or major item, like the frame or the slab, they will send you the invoice. So at this stage, it's really important that you would go and have a look at the site to say, yep, the slab is poured. And then you would sign the invoice to say you authorise the bank to pay this invoice. You would then send it to us, then we would send it to the bank and get it paid for you. And then we also communicate with the builder to let the builder know that it's been paid and yourself. So we manage everything from start to handover for you.
And that's something a bit unique that we do at Rise High, where we will actually manage the progress payment process for you, and that takes away a lot of the stress for you, because we manage all that and all the paperwork and make sure the builder gets paid, and you can just focus on getting ready to move into your new home, which is the exciting part.
You get to see it come to life.
Let's talk about timeframes.
Yes.
You know, timeframes are such an important thing, and timeframes from every perspective. So timeframes for finance, timeframes for, you know, the build process, timeframes for council approval, timeframes for settlement. Let's put some things. Let's start with finance approval.
Okay.
You know, what can people expect in terms of timeframes around finance approval?
Okay, so depending bank to bank, but we're looking at maybe a 2 to 3 week time frame for finance approval, for full approval, along with your pre-approval. And then by the time you give us all the documentation, including quotes for the build, it could take another 2 to 3 weeks for that to be finalised. And this is allowing bank a bit of time to catch up with all the applications as well. So you're looking at about 3 weeks, I think, would be a good time frame to get finance fully approved.
We had a question come through from Roger about, he basically said that his bank, or when he did his application, he was required to get council approval before they would give him finance approval. Said, is that common, or are there other banks that can give you finance approval before council approval?
Yeah, there are banks that can give you formal approval without the council approval, but they won't start releasing the money for the construction until you have council approval.
So it might be that you can get the finance approval before council approval, but you need the council approval before you start construction.
Correct. And the time frame for you, from the time that you talk to the builder to the time that you are ready for the final costings, it could take about, and council, could take about 2 to 3 months.
Yeah. Council can be a long process.
It can.
I mean, sometimes you get lucky and it's quick.
Yeah.
But other times, I mean, what sort of time frame do you think people should have in their mind for the council approval process?
At the moment, I'm thinking demand and supply, maybe 3 to 4 months.
Yeah. So you can see that that's probably, if you are sort of anxious about your finance approval, then maybe you want to go with a lender who will approve your finance before you get council approval, so that you can be comfortable that you're going to secure the land.
Yeah.
And then, but saying that, it is also a good option to go with the banks that need the council approval. So it's really about weighing up the pros and cons of each option, isn't it?
Yes, it is. Yep.
So we've talked about finance approval, we talked about council approval. What can people expect for settlement? Like, how long does the build process generally take? From the time that they start the process to the time that they finish the process, how long can they expect that to take on average?
So when we get you the build loan that's formally approved, you sign the loan documents, then the bank will issue your builder with a commencement letter, generally, to say that we are ready to fund. Once the builder receives that letter, that's when they can prepare your file to go to construction site. And that depends on the builder. It could take a couple of weeks, it could take a month, depending on how busy they are. But once they start construction, it can be quite quick. And it depends on what the builder has signed up with you. But we're looking at about potentially 6 months to 8 months for a build. Sometimes they can even do it quicker. But once it starts, it happens quite quickly.
And another tip, speaking from experience again on this side of things, is that it's always a good idea to make your builder commit to a time frame in the contract.
Yes.
So, often we see clients who have been able to negotiate an end date for the build and penalty clauses for the builder if they exceed that end date. So if that's important to you, then you can negotiate a date of completion, and you can negotiate with the builder that if they don't meet that completion date, then they have to actually pay you a penalty fee for every week or fortnight that they're over that penalty date. So that can be something that you can do as well.
Yes.
So let's say we've gotten to the end of the build, we've moved in. What happens next? What are the next things? What's important to consider once you're in your new house and your loan is fully drawn? What's next?
Make sure you've got the house insured.
Yes, that's so important.
Really
it's so important because normally through the building process, the builder's insurance or indemnity insurance will cover it, but you need to make sure that from handover onwards that you've got the building insurance.
Correct. So when you get the keys to the house, you have to make sure that you have adequate building insurance to cover the building in case of fire, flood, anything like that. You can get the house rebuilt. And content, that's up to you, but the minimum is building insurance. You may need to talk to the builder about the lock, changing locks, or a lot of them do offer you a lock special key to reset the locks, and obviously
and then you've
buying
got the
furniture,
moving in process, buying furniture. So make sure that you've factored in the cost of that in your cash flow budget when you've gone to do that. I guess the other thing that's really important is that when you initially set up your construction loan for your build or your renovation, you're choosing the right loan for you at that point in time.
Yes.
But once your construction is finished, it doesn't necessarily mean that loan is the right loan for you moving forward. So how important do you think it is for people to review their loan after the construction period is over and potentially even revalue their house at that point if they wanted to? And how, what time frame would you say between completion of the house to reviewing the loan would be a good time frame to check in again?
So after the house is complete, the valuation, if you decide to do a valuation, that could be quite different to what your contract quote is. So if you require additional money, that would be a good time to revalue your house to see whether there's equity that we could pull out to help you with the landscaping or anything like that. I generally think people, the last thing they think about when they move into the house is refinancing.
Yep.
So it's more about a year to 2 years down the track is a good time to review it.
Yeah, get settled into the house, but it is a good idea, you would say, to review it within 12 to 24 months.
Yeah, definitely look into that. Like again, if you need funds sooner, then we can definitely order a valuation and see what the valuing comes in at for you.
Well, that has been super helpful, Thuy. Thanks for joining me today.
Thank you.
We've had
Pleasure.
lots of information to share with you today, and hopefully that's been useful to you. We are always here at Rise High to answer any of your questions, so please reach out to us at any time. Yes. We would love to help you with your new home. So thanks for joining us, Thuy, and we will see you again next time. Thanks, guys. Bye.